Okay, so let's unpack this. Welcome back to Talk Tickers. The mission for today's deep dive is slicing right through the corporate jargon of LyondellBasell's Q2 2026 earnings call.
Right.
Ticker symbol is LYB. And we want to figure out what this all actually means for the retail investor.
Yeah, because it's dense. I mean, it's a stack of heavy industry financial data.
Oh, absolutely. It's like reading a chemistry textbook crossed with an economics thesis. But we need to look at how global geopolitics is directly moving the needle on raw material costs and corporate profits for this company.
Exactly. And to set the stage here, LyondellBasell, they are a massive global chemical and plastics company.
Massive.
Right. And their earnings call just revealed exactly how sensitive they are to global supply chains. I mean, the materials they make, they're completely invisible to the average consumer.
Yeah, you don't buy a bottle of LyondellBasell at the store.
Right. No, you don't. But if you touch anything plastic today, or drive a car, or even just use a data center, you're interacting with their baseline materials.
They're essentially the flour in the global economic bakery.
Oh, I like that. Yeah.
Like, you don't buy flour to just eat it, but you literally can't make the cake without it. And they make the flour.
That is a perfect analogy. And this call was basically a high-definition X-ray of that exact bakery.
So we know what they make. Now let's look at how much money they made doing it, because the headline numbers for Q2 are they're kind of absurd.
They really are. It was a blowout quarter.
Let's do the data drop. They posted earnings per share of $4.30.
Which is strong on its own.
Right. But the metric that truly jumps off the page is their EBITDA. It hit $2.1 billion.
Yeah, $2.1 billion.
Which is more than tripled sequentially from Q1. I mean, they tripled their core earnings in 3 months.
It's staggering.
And they pulled off a massive 23% overall EBITDA margin.
And we really need to pause on that 23% number. Because in a heavily cyclical, super capital-intensive industry like petrochemicals, I mean, printing a 23% margin, it's the equivalent of hitting a grand slam. It just shows incredible operational leverage. But what's fascinating here is when you drill down into their standout segment.
O&P Americas, right?
Exactly, the Olefins and Polyolefins Americas segment.
Right.
This one specific division posted an eye-watering $1.3 billion in EBITDA.
Wow.
Just on its own. And that is 4 times higher than the exact same quarter last year.
4 times higher. That's insane.
And get this, the margin for that specific segment was a staggering 36%.
Okay, wait. 36% margin on heavy manufacturing.
Yeah. Plus, they ended the quarter sitting on $2.6 billion in cash.
Right.
And $7.1 billion in total liquidity. So the balance sheet is basically a fortress right now.
Okay, I have to step in here and challenge this a little bit.
Sure.
Because I'm looking at this 23% overall margin celebration, and especially that 36% segment margin. Petrochemicals is famously cyclical.
Very cyclical, boom and bust.
Right, it's a boom and bust commodity business.
Right.
And historically, when margins hit those kinds of extreme, ridiculous highs, that is the exact moment retail investors should be terrified.
Well, yes, usually.
Because it usually signals the absolute peak of the mountain right before a terrifying drop.
Yeah.
Right. Because fat margins inevitably incentivize all the competitors to flood the market with new supply.
They turn on every factory they have.
Exactly, which crushes prices. So wait, how does a chemical giant triple its EBITDA in 3 months? Did everyone just suddenly buy 3 times as much plastic? Or is something else going on? Why isn't this massive margin print just a giant red flag that we are at a cyclical top?
It's a great question. And in a normal macroeconomic cycle, you would be absolutely right to view this with total suspicion.
Okay.
Because high margins usually cure high margins.
Right.
But the underlying mechanics of this specific cycle they're just fundamentally broken right now. Demand didn't triple.
It didn't.
No, demand has actually remained pretty flat, relatively stable. What triggered this windfall was an unprecedented collapse in global supply. And LyondellBasell just happened to be perfectly positioned geographically to capitalize on that void.
Okay, so let's get into the mechanics of that supply collapse, because this is the story behind the numbers. This is where the geopolitics completely overwrites the standard financial models.
Exactly.
We are talking about the ongoing conflict in the Middle East.
Yes. So the Middle East is traditionally this massive, super reliable hub for global petrochemical production.
Right.
But the conflict there has taken roughly 6 million tons of polyethylene capacity offline.
6 million tons. I mean, management noted on the call that this represents about 20 to 25% of all Middle East supply just vanishing.
Just gone from the global market. And crucially, this addresses your concern about a cyclical crash. Management explicitly confirmed on the call that this structural damage is sustained.
Because it's not coming back tomorrow.
No. They do not expect those 6 million tons to even begin restarting until at least 2027.
Okay, so a quarter of the Middle East's output is just offline for years, not months.
Exactly.
Naturally, when supply drops that drastically, the global price of the commodity spikes. But here's the piece I need you to translate for me.
Oh.
A 36% margin in their Americas segment means they weren't just selling at those newly elevated global prices, right? Their internal manufacturing costs must have remained completely insulated from the crisis.
That is the structural advantage. It's the key to this whole quarter.
Okay.
It comes down to feedstocks. So in the chemical manufacturing world, your primary raw material is called your feedstock.
Right.
You take a raw hydrocarbon, you put it inside a massive furnace, and you literally crack it under immense heat to create the building blocks of plastic.
So it's like running a pizza shop where your cheese costs half as much as your rival across town.
That is exactly what it's like.
Like all the other pizza shops have to raise their slice prices to $5 just to break even because their cheese is so expensive.
Right.
But your cheese is still dirt cheap. So you also charge $5 a slice, but you get to pocket all that extra profit.
That is the perfect way to look at it. Because in the global petrochemical market, the two primary feedstocks, the cheese in your analogy, are crude oil and natural gas. Most international competitors, especially in Europe and Asia, they rely heavily on a crude oil derivative called naphtha.
Naphtha, right.
So when global crude oil prices spike, which they have because of the Middle East conflict, the baseline cost for those international facilities to make a single pound of plastic just skyrockets.
But LyondellBasell's Americas segment is running on completely different ingredients.
Yes. They make roughly 80% of their global ethylene using cost-advantaged U.S. natural gas, specifically a molecule called ethane.
And the U.S. has a massive abundance of natural gas.
Exactly. So domestic U.S. natural gas prices have stayed incredibly low compared to global crude oil. So while international competitors are getting crushed by high naphtha costs, LyondellBasell is using cheap domestic ethane.
Wow.
The profit spread just exploded. Management even pointed out that while global selling prices went up, their internal costs for ethane actually went down during the quarter.
That is the ultimate geographic arbitrage.
It really is.
But wait, if we connect this to the bigger picture, there is a secondary geopolitical ripple effect here that I found completely fascinating.
Oh, the China surprise.
Yes, the China surprise.
Yeah.
Standard economic theory says you have this massive supply shock in the Middle East. So a giant consumer base like China would normally just immediately panic buy from the US or Europe to secure their supply chains, right?
That is what everyone expected.
But they didn't do that.
No. China structurally adapted in a way that shocked even the most experienced analysts. Instead of importing plastic at those premium prices, they actually started exporting to Southeast Asia.
Wait, exporting? How does a massive net importer suddenly become an exporter without just destroying their own manufacturing base?
Well, they pulled an emergency lever. They dramatically ramped up coal to olefins production, CTO.
So they're literally using coal to synthesize plastic.
Yes. Through this very complex gasification process. Now, usually CTO is highly capital intensive. It's terrible for the environment. It uses massive amounts of water, and the conversion efficiency is awful.
Right, it's usually too expensive to run.
It normally sits at the absolute highest end of the cost curve. But the Middle East shock sent crude prices so high while domestic coal in China stayed flat that suddenly this incredibly inefficient process became profitable.
That is wild.
So they used their dormant coal infrastructure to offset their imports and then exported their existing stockpiles to capture the high international prices.
But the result of that, the result of draining your own domestic reserves to export to your neighbors, is that Chinese polyethylene inventories have just plummeted.
Yes, they are down roughly 30% below pre-conflict levels.
30%. That is a massive amount of their inventory buffer just gone.
It really is.
Okay, so that covers the core plastics business, which is a gold mine right now. But Q2 wasn't just about plastic. We need to talk about their intermediates and derivatives segment.
The oxyfuels.
Yes, the oxyfuels bonus. Because they are holding the winning lottery ticket in a completely separate global supply chain disruption.
It's true. So oxyfuels, they're basically high-octane gasoline blend stocks. Refineries use them to boost the octane level in finished gasoline. And right now, gasoline crack spreads, which is the profit margin for refining crude into gas, they are near record levels.
And this is because of the Ukraine war, right?
Exactly. The war has essentially idled about 40% of Russian refining capacity.
40%.
Yeah. So global supplies of refined products are super tight. Refineries are desperate for octane-boosting components.
And LyondellBasell makes these oxyfuels using, again, cheap U.S. natural gas derivatives like butane and methanol, not crude oil.
You got it. They rode this massive wave perfectly.
Yeah.
The margin environment for oxyfuels is one of the strongest they've ever seen.
Okay, so you look at all of this. The Middle East plastic shortage, the Eastern European refining shortage. Q2 sounds like absolute operational perfection. But this is the part that kind of blew my mind.
The outage.
Yeah, Q2 wasn't even a perfect quarter for them. They had a severe operational failure right in the middle of all this.
They did. They suffered a major unplanned outage at their Bayport facility down in Texas.
And that's a critical plant for them.
Very critical, especially for oxyfuels. When a plant like that goes down unexpectedly, it is a big deal. You have to safely vent it, inspect for damage, meticulously restart it.
And management said that specific outage cost them an estimated $250 million in lost EBITDA.
$250 million, just gone.
And they still printed $2.1 billion in overall EBITDA. That is what's so crazy.
Well, they had to quickly spin up a second quartile asset at another site just to bridge the gap.
Okay, plain language for the retail investor. Second quartile basically means it's an older, much less efficient plant, right?
Right. It uses more energy, has a lower chemical yield, it eats directly into your profit margins. So they fought this quarter with one hand tied behind their back using older machinery and still crushed it.
Which means moving into Q3, they have the primary Bayport asset back online and fully ramped up.
Exactly. It restarted safely in June.
Okay, so Q2 was a gold mine, but investors buy stocks for the future. What did management say about Q3 and beyond? What's the guidance?
They explicitly stated that market normalization is going to take quarters, not months.
So this highly profitable environment isn't vanishing tomorrow.
No. And because global inventories are so lean, especially with that China situation we talked about, LyondellBasell actually announced another $1.10 per pound price increase for polyethylene in August.
A 10-cent price hike.
Yeah.
When you can force a price hike on a baseline commodity, that is pure pricing power.
It is a seller's market.
But I want to call out a specific risk I saw in the guidance. Because management mentioned that in the Americas, Q3 operating rates are dropping. They're going from 90% utilization down to roughly 85%.
Right.
If I see a factory slowing down its assembly line, my first thought is, uh-oh, demand is drying up. Are they losing orders?
No, and it's super important to clarify this. It is not due to weak demand. This drop is entirely due to planned maintenance. They call them turnarounds.
Turnaround.
Yeah, they have major turnarounds planned at their Clinton and Lake Charles facilities. The Clinton one is a 70-day outage.
70 days of zero production from that unit.
Right, because when you run these massive plants at 90% capacity for months, you have to eventually take them offline to inspect the pipes, replace catalysts, ensure they run safely.
It's capital expenditure.
Yeah, it's planned downtime.
Right.
They actually built up excess inventory in Q2 just so they wouldn't short their customers during this Q3 turnaround.
Okay, that makes sense. So they're generating all this cash, the market is tight. The big question for the retail investor is capital allocation.
The cash plan.
Yes, what are they doing with the money? Because a management team can easily destroy shareholder value by getting reckless, going out and buying flashy competitors in M&A deals.
Oh, they are doing the exact opposite. They are ruthlessly focused on internal efficiency. They have reduced headcount by 3,400 employees.
Which is 17% of their workforce.
Right.
That is a massive corporate diet while you're highly profitable.
They are trying to hit a $500 million cash flow improvement target by 2026. So instead of flashy M&A, the CFO was very clear. They are focused on maintaining an investment-grade balance sheet and paying dividends.
They are building a fortress.
Exactly.
Okay, so let's bring it all together. We've dissected the Middle East, the U.S. natural gas advantage, the China surprise, the job cuts. What is the bottom line here? For a retail investor looking at LYB, is this a bullish or bearish signal?
I take a definitively bullish stance for the near to medium term.
Okay, why?
The macro environment has created a structural multi-year tailwind for them. You have Middle East outages locked in until 2027. Russian refineries are offline, boosting their oxyfuels, and they have U.S.-based, cost-advantaged assets.
It's the perfect storm for them.
It is. And the kicker is that they printed a 23% margin in Q2. Even though they suffered that $250 million Bayport outage, it wasn't even a perfect operational quarter, and they still crushed it.
So the actionable takeaway for someone holding or considering the stock, that this is a cash-generating machine right now.
Yeah.
They are slashing corporate fat, cutting 17% of jobs, and selling into a severely supply-constrained global market.
That's the bottom line.
All right, well, thank you for tuning in to Talk Tickers. We really covered a massive amount of ground today. But before we sign off, I want to leave everyone with a final provocative thought, something to mull over as we watch these commodity markets.
I think I know where you're going with this.
It goes back to the China surprise. Management estimated that Chinese polyethylene inventories are down 30%. They drained their reserves to export and capture high prices.
Right.
But they have to restock eventually. You can't run an economy on empty. So when the world's biggest buyer suddenly flips from exporting back to aggressively importing, and they have to do it in a market that's already structurally short 6 million tons of supply, just how high could these margins actually go?